Hey guys, welcome to another video. Today I want to go over why I prefer investing in stocks as opposed to gold or Bitcoin. And then I want to look at 3 ways by which companies make sure that you're making money when you invest in their stocks. Let's get into it. What's the point of owning stocks? Stocks are considered as productive assets, meaning if picked correctly, they can actually produce returns on their own. Some would call this passive income, where the money that you make does not correlate to the amount of hours of work that you're putting in. The work is done once and the fruits of the labor are felt forever. When you use your money to buy a company, that money can make more money automatically without you having to do a thing. But I'll talk about this a bit later. According to the legendary investor Warren Buffett, gold or Bitcoin are non-productive assets, or assets that will never produce anything. People will purchase this type of asset hoping that someone else in the future will be willing to pay more for it. That is the only way to make money with this type of investment because it doesn't produce anything. People usually invest in gold or Bitcoin because they fear the system or the devaluation of currencies like the dollar. And I see where they're coming from. But 1 ounce of gold will always be 1 ounce of gold. 1 Bitcoin will still be 1 Bitcoin in 100 years. Now think of a productive asset like Apple. If you own Apple for 100 years, you will have produced millions of products. Think of iPhones, iPads, you name it. And whether the currency in 100 years is dollars, bitcoins, gold, shark teeth, people will still be willing to exchange minutes of their labor for Apple products. The bottom line is, businesses make products and offer services that people are willing to pay for. Warren Buffett compares them to commercial cows. These cows have the potential to live forever and produce more and more milk every year. And more importantly, their value will not come from the method of exchange, but rather the quantity of milk they produce. In summary, when I make an investment, I like to know that the money I'm putting into it will make me more money passively, whether I sell it or not. I don't invest in non-productive assets like gold or Bitcoin in the hopes that their value will eventually go up just because more people will be more interested in owning it. And if I did want to go down that road, I would probably prefer to buy a painting or a sculpture rather than something like gold or Bitcoin. I mean, at least I can enjoy looking at a painting. Now, you might be asking yourself, how can my money make me more money passively when I buy into stocks? After all, you're just buying a ticker symbol at a certain price and hoping the price goes up so you can sell it for profit, right? Well, if you look at it that way, yes. Stocks can be seen as non-productive assets like gold, Bitcoin, or Pokemon cards. But the reality is, stocks are still small percentages of a business, and businesses can be profit-generating machines. Let's go through the main ways by which your money can make you more money when you become part owner of a business. This is the most straightforward way and the easiest one to wrap your head around. Keep in mind that earnings is just another word for profits, aka the amount of money a company keeps from their revenues. So let's say you own 10% of a company that makes $1 million in profit every year. Then 100,000 of these profits belong to you. In this case, you won't see the money land in your personal account. Instead, the money lands in the account of the company you own. Remember, when you invest, you are actually part owner of a company. In financial terms, this 100,000 profit is referred to as earnings per share, or EPS for short. Usually, the EPS is displayed on financial statements and refers to the profit made for each stock of the company. Companies usually trade at a multiple of the EPS. The historical average of that multiple ranges from 10 to 20. What does this mean? If company ABC makes $1 in earnings per share, and we use a multiple of 10, then each share of company ABC will trade for, well, 1 times 10, which is $10. This means you are paying $10 to get $1 of profit per year. If the company grows year after year and the EPS gets larger, then your share of the company will be worth more and more. If company ABC makes $10 in earnings per share in 2021, and we assign it to a multiple of 10, then the price of the stock will be worth $100.
If in 2022 the EPS goes from $10 to $12, then the shares will be worth $120. Ta-da! You just made a profit of $20 per share in 1 year, and this is because your shares became more valuable. This extra value comes from the fact that the company is making more profit. But what if the company is not growing? Good question. Let's say you own a lemonade stand that makes $10 every day of the week and that you can keep this up forever. The daily earnings made from that lemonade stand never increases, but the cash in your business's bank account does, right? That means $10 every day that is going straight into your bank account. If your friend comes along and wants to buy half of your business from you, would they have to pay more when you're just starting out, or would they have to pay more when you're 3 years in and have more than $10K in the bank? The point is, when you own a company and it makes money, so do you.
Businesses can use their earnings in many different ways to grow and create value for their shareholders. Sometimes the earnings can be kept in cash, as we saw in the lemonade stand example. Businesses can make acquisitions, which means buying out other businesses. One example of this would be Amazon buying out Whole Foods to enter the retail industry, or Facebook buying out WhatsApp or Instagram. But the tricky thing with acquisitions is that they don't always deliver value. In fact, most of the time, businesses can lose money by making acquisitions. This phenomenon is actually quite interesting and is worth looking at in more detail, but I will leave that for another video. Businesses can also reinvest their earnings in order to do more research or build factories, etc. But these are investments in and of themselves, and it is not guaranteed that companies will reap the benefits. There are two things that companies can do with their earnings to mechanically provide value to their shareholders and create that passive income feeling that we were talking about earlier. The total number of shares that a company has is fluid. Companies can create more shares and sell them in order to make more money, or they can use their earnings to buy back old shares in order to reduce the number of shares available. When a business decides to buy back their own shares, it is essentially canceling or destroying shares that exist. How does this bring value to us investors? Well, a quick example will help illustrate that.
Let's say a business has 100 shares outstanding and you own 5 of them. Your percentage of ownership in this case is 5%. If the business suddenly repurchases 10 of its shares, now you own 5 out of 90 shares. And just like that, your ownership of the company just went from 5% to 5.6% without you even having to move a finger. Apple is an example of a company that loves to aggressively buy back its own shares. Apple went from 26.5 billion shares in 2013 to 17 billion in 2020. This means that if you held onto your Apple shares during this period, your percentage ownership of Apple increased by 36%. That's cool and all, but how do I make money from increasing my ownership in a business? To explain that, we need to go back to the EPS. Say company ABC makes $1 million in earnings per share, and that this company has 100,000 shares outstanding. After some quick maths, we can say that this company makes $10 of earnings per share. Now, if company ABC starts buying back its shares and the share count goes from 100,000 to 80,000, then the company is still making $1 million in earnings per share. Since there are less shares to divide the profit, the EPS now increases to 12.50. Because the earnings per share has increased, your shares are now worth more and the share price will go up automatically. It's a beautiful thing, isn't it? This is a great form of passive income, even if you don't see the money directly.
The last thing that businesses can do to provide passive income to their shareholders, and probably one of my favorite things, is to give out dividends. Dividends is just another word for cash that comes straight into your bank account. When a business is making a lot of profit and has no way to reinvest that money at a high rate of return, well, guess what? They might decide to pay out a part of it to its owners, aka us, the investors.
If company ABC makes $1 million in profit, and they decide to give 50% of it to their shareholders, they will be giving out $500K in dividends. Taking into account that company ABC has 100,000 shares, then each share will receive $5 at the end of the year. If you own 10 shares of the company, you would receive $50 in total. Usually, this dividend is expressed as a dividend yield, which is the percentage you get in dividends relative to the price of the share. For example, we can see here that Coca-Cola gives out 3.16% dividend yield. 3.16% of 53.14 is equal to roughly $1.68 paid out per share in dividends every year. It's important to understand that when a stock goes up or down in price, the dividend yield changes in the opposite direction. If a company's stock is selling for $100 and they pay out $5 in dividends per share, the dividend yield will be at 5%. Pretty straightforward. Say the price stock goes down to $50, the yield doubles to 10% since the company still pays $5 in dividends per share. Conversely, if the stock price goes up to $150, the dividend yield goes down to 3.3%. So basically, the dividend yield is an indication of how many dividends you are getting for your money at the current share price.
Dividends usually pay out every quarter, aka 4 times a year. This is a true form of passive income because you can expect the money to come into your bank account like clockwork, as long as the business is profitable. Not only that, but if a business is growing, it will usually try to increase its dividends paid out every year. This means that if you're receiving $5 per share in 2021, by 2025, you will be earning $8 to $9 per share simply because you're investing in a profitable company.
Check out this graph from Seeking Alpha. Here they show Coca-Cola's dividend history from 1990 to today. You can see that the amount they pay out is steadily increasing year over year. In 1990, shareholders were receiving 2 cents per share every quarter, but today that amount has gone up to 42 cents. That's a huge increase. Warren Buffett, who bought 400 million shares of Coca-Cola in 1988, received $656 million in dividends in 2020 just from them. Granted, he is one of the richest people on earth, but plenty of regular people these days are able to make substantial amounts that allow them to retire at an early age and live a comfortable life. So it's possible.
I'll be talking a lot about dividends on this channel and you don't want to miss any of it, so please make sure to hit that subscribe button. Also, if you got something out of the video, make sure to hit that like button. It helps out the channel a lot. See you next time.